So let's talk about what's market in real estate deals in raising capital on the equity side, structures, how people are doing it. So let me share my screen and I'll go over some of the common structures that we're seeing in terms of people out raising capital. All right, so traditionally you might have something like a fund or a syndication where you've got in yellow the asset itself being acquired by a legal entity like a limited partnership or an LLC. You've got investors who are in the green box here, LPs that come in, give the cash, the GP who runs the deal. So that's pretty common structure in a fund. Sometimes a fund will be a one deal or it'll go after multiple deals. This is for multiple real estate with SPVs at each level underneath the fund. Now we're also seeing a lot based on the capital markets and the cost of capital of debt funds. So here's a sample of a debt fund using promissory notes. So the fund is the gray box here, and it's owned and managed by a management LLC that's usually owned completely by the sponsors or the people putting the deal together. The investors of the green box over here, they're given promissory notes, essentially loaning money to the fund. And they might be a short-term note, like a 12-month note with maybe 8 or 10% interest, plus their capital back at the end of the first year. And so that's where the fund gets its capital. It's basically loaned from investors. Then the fund then turns around and loans the money it has to an operating company. And here we have XYZ Holdings, just to put a name in there, under some kind of an agreement. So maybe there's a line of credit, promissory note, whatever it is. So the money goes from the fund, first from the investors to the fund, then the fund loans it over to the operating company. The operating company maybe buys tracts of land, develops things, whatever it is up here on, let's say this is for real estate. Then as they get paid, they pay down the loan, it goes the opposite direction, and they pay interest and principal back to the promissory note holders. So those are pretty common debt funds or private credit. One other one that we're seeing quite a bit is, let's see here, is pref equity. So a lot of real estate deals are having a hard time bringing in retail capital, essentially syndicators who are trying to bring in money to close a deal on a property are having a hard time with their traditional network of people. So they're switching either from 506B to 506C and going out into more of a public market and generally soliciting to find more investors, or they're having to fill the gap with mezzanine debt, or one of the most common things we're seeing is pref equity. So in this structure, this is a traditional, whether you want to call it a single asset fund or a syndication. The gray box is still the fund or syndicate entity. Green box is still the regular investors and the sponsors down here in the manager entity. Now, it adds a little bit more complexity because it adds the yellow box. The yellow box is a joint venture entity. It's an LLC that splits things up between the fund or syndication and a pref equity partner, this yellow box over here, the JV partner. So that partner comes in and they're usually dictating the terms of, these are the big check writers that come in and say, hey, I'll put another 4 million, I'll write you a check for 4 million so you can close your deal and close on the property. But I want whatever it is, 15% preferred return, 18% preferred return, just depends on what the negotiated terms are. They usually take some protective provisions that are put in, protects them upon sale or forced sale. They can take over this manager entity in some cases if their payments are not being made. There's a lot of terms that go into that, but those are pretty common right now to fill that gap to close deals. So these pref equity, there's been a lot of them that have created pref equity funds that are coming into the market saying, hey, we'll help you close your deal, but we're going to ask for some pretty significant terms. We're going to get paid out 15 to 20% per year for like a 2-year period and then get our capital back and then we're done. Then this yellow box basically disappears. And then all you have left is your regular investors and the syndicate or fund entity. So we're seeing a lot of those. Those are pretty common. But that's basically the state of things. Deals are still being done and transactions are still closing, but a lot of times they're taking longer to raise the capital. So they have to bring in some kind of additional debt or equity, pref equity to close the transaction.